Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in financial documents, and boy do we have a story for you today. Semnur Pharmaceuticals Inc. is trying to revolutionize pain management, but it seems like their journey is as painful as the conditions they're trying to treat. Imagine a company right on the cusp of launching its first big product, but then facing a ton of regulatory hurdles and financial challenges. That is Semnur Pharmaceuticals for you. They're trying to bring a non-opioid pain relief drug to market called SPE-102. And let me tell you, the road has been anything but smooth. From FDA meetings that did not go as planned to major business combinations, this filing is packed with details that paint a vivid picture of their uphill battle. Let's dive into their financials to see how they're holding up. First off, take a look at these numbers for the year ended the 31st of December 2024. Their total operating expenses were almost $4.7 million. That might sound like a lot, but when you see their revenue, oh wait, there is no revenue from product sales here. Zero zip nada. This is typical for a company in their stage of development, but it does highlight their massive reliance on funding. They reported a net loss of over $4.6 million. For a company with no sales, your losses are the main story, and here they are pretty significant. Now shifting over to their balance sheet as of the 31st of December 2024, we see a company with very little cash, just about $12,000, and a massive accumulated deficit of over $115 million. Those numbers are stark reminders of how much money is needed to get a drug from the lab to the shelf. And look at this, over $49 million in related party loans. This indicates a significant financial dependence on Silex Holding Company, their parent. Let's fast forward to the more recent unaudited numbers for the 30th of September 2025, and wow, things have gotten much more dramatic. Their operating expenses shot up to over $152 million for just 3 months period. What happened all of a sudden? That jump is primarily driven by general and administrative costs, which surged to over $151 million in just 3 months. This is mostly due to consultant expenses for shares issued at closing and deferred offering costs being written off. It is a huge one-time hit, but also shows the massive costs associated with their big business combination. Their net loss in this same 3-month period was a staggering $152 million. Ouch. That is a lot gone in a very short time. Looking at their stockholders, deficit shows a similar story, with an accumulated deficit soaring to nearly $270 million by September 2025. But here is something interesting. They issued preferred stock and common stock worth over $54 million for a debt exchange agreement. This means they are restructuring their debts, converting debt into equity, which can be a smart move to lighten the debt load, and a big jump in additional paid-in capital to over $255 million. This is likely due to the business combination and issuing shares to consultants and underwriters as part of that deal. In their cash flow statement for the 9 months ended September 2025, they used up over $2 million in operating activities, but they got over $2 million from financing activities. This indicates they are managing to bring in cash through loans and likely from the equity issuances we just talked about. Again, we see significant proceeds from related party loans, which means their parent company Silex is still providing crucial financial support. Now let's talk risks, because this filing is full of them. They openly admit they have a limited operating history, a single product candidate, SEBI-102, and significant losses. They are highly dependent on the success of SP-102, and there is no guarantee it will ever get approved or be profitable. This is a big red flag for any investor. They are essentially betting their entire future on this one drug, and they rely heavily on outside companies to run their trials. If those companies mess up, Semnur's drug development timeline could be in serious trouble. Then we get to the crypto part. They plan to use proceeds from a Bitcoin deal to fund other investments. The filing warns you that Bitcoin is super volatile and could make their stock price do wild swings. They openly say their crypto treasury strategy has not been implemented or tested. This is a massive gamble. They're basically saying we haven't done this before. It is risky, but hey, it might work. Now for the people running the show, their top executives like Jaisim Shah and Henry Jai are getting substantial salaries and stock options, especially after the business combination. Jaisim Shah's salary is over $1.2 million plus a bonus potential of 150%. Henry Jai is set to make over $1.1 million with a similar bonus potential. Stephen Ma, the CFO, also has a solid compensation package. These are big numbers for a company that is not yet profitable. They've also got a pretty big board of directors with a lot of different backgrounds, from neurosurgery experts to business consultants. It looks like they're trying to cover all bases. And who owns the company? Silex Holding Company, their parent, holds a massive chunk, over 82% of the voting power. That means Silex essentially calls the shots. By economy, PTE. also holds a slice of about 5.4%. The insiders like Jaisim Shah and Henry Jai hold shares through their stock options, which are still not exercisable because of that Aurum note. Remember that note we saw in the finance section? That is still a big roadblock. This concentration of ownership by Silex means minority shareholders have very little sway. They are pretty much along for the ride Silex decides to take. They're registering a ton of shares for resale by various parties like Silex, their early sponsors, and even some underwriters who got paid in stock. This means a lot of shares could hit the market, potentially putting downward pressure on the stock price. And these selling security holders might be deemed underwriters, which is a fancy way of saying they are essentially selling these shares like a brokerage firm would. So what is the story here? Semnur Pharmaceuticals is a company with a lot of promise. If their SEPI -102 drug works and gets approved, it could be a game changer in pain management. But the risks are immense. The company is burning through cash faces significant regulatory hurdles, is heavily reliant on its parent company, and is taking on even more risk with a cryptocurrency strategy that is completely untested. Their executives are well compensated, but the path to profitability is long and uncertain. Looking at the financial tables, the surge in general and administrative expenses in the recent period is eye-popping, but it is mainly tied to the business combination, which is a one-time sort of event. The real concern is the core business operations. They have zero revenue at this point and a sky-high accumulated deficit. Their dependence on Silex is also a huge factor. If Silex faces financial trouble, it could directly impact Semnur's ability to operate and get funding. The big gamble on Bitcoin adds another layer of extreme uncertainty. In conclusion, Semnur is a high-risk, high-reward play. If SP-102 is a big success and they navigate all these complex financial and regulatory landscapes, the payoff could be huge. But the odds are stacked against them, and many things have to go perfectly for them to succeed. I'd say be extremely cautious if you are considering investing here. Alright, that is our deep dive into Semnur Pharmaceuticals' latest filing. What are your thoughts on their strategy, and risks are they on the path to pain relief for patients and profit for investors? Let us know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe to Corporate Decoder for more. And remember to check out our Discord community linked in the description for even more insights and discussions. Thanks for watching, and see you on the next Decode.